Happy Friday, Eric Bible with the Bible team at Neil Home Loans. Another intriguing week in the markets where, yes, this morning, the 30-year fixed is up from last week's low of 6.88 to this morning 6.9. We've seen a pullback as this week we almost touched 7% again. And it comes down to the fact, as the title reads, the market is not taking the bait on outdated data. So let's dive into it. Ultimately, what drove interest rate volatility this week and landed where we were today was around key economic reports and a component painting a picture of the economy being more robust than initially thought. But really, the underlying tones combat that narrative in that the economy is actually not as strong as we believed. And in turn, the credence to the Fed of being in a position to cut rates in the not so distant future is becoming more and more real. So let's dive in. First and foremost, GDP, gross domestic product. What this measures is really output of our nation, what we produce, and in turn, what is consumed. Thursday, we received an inflationary number, the first reading for fourth quarter, and it blew past expectations. Market was expecting performance at 2%, but in turn, we got 3.3. And right there, we thought, oh boy, here we go. Fed's going to punt cutting until late summer, possibly even into next year. But the underlying component, which is called GDP deflationary, painted a much different picture. And that component takes into account the cost of money. As we know, inflation has been present, yet it has been coming down. And there it came in at 1.5, which yesterday sparked a very sharp rally, pulling rates off the week highs of 6.98 to the 6.9. And it's looking like we could see more rally today, and I'll get to why here in a second. Why this is so important. Yes, it's outdated data. So that headline number 3.3 on GDP, in normal context, strong, robust, humming economy. When we take into account the inflation we've experienced over the last 2 years and the amount of government spending we've seen, 365 billion alone in the last 3 months, the market is realizing that this can't continue. At some point, the piper is going to need to be paid, which in turn, those dollars will be pulled out of the economy. And if we start looking at the real components driving it, there is cause to believe that the economy is not as strong as we once believed. Secondary component, initial jobless claims and continuing claims. As we've seen some volatility over the last few weeks, and as I mentioned last week, the numbers that were reported on a week-by-week basis included the holidays. And holidays, it throws everyone for a loop, and in turn, individuals are typically not looking for new employment. Employers typically aren't firing, laying off, just again with the holidays. So now inside a normal cycle, we saw both those reports show increases. We showed an increase in initial jobless claims, individuals filing for unemployment for the first time, and an increase in individuals filing for continuation of claims, all painting the picture that the labor market is not as robust as once believed. And again, two important mandates on behalf of the Fed: maximum employment and inflation at 2%, price stability. Employment showing those signs in those initial claims definitely paints the picture that the employment market is starting to suffer. And then lastly, we come to PCE, which was released this morning, personal consumption expenditures, the Fed's favorite measure of inflation. Every indication around the Fed is targeting 2%. This is what the Fed is talking about. So this morning, we got PCE. The month over month reading was expected to come in at 0.2. We got just that, 0.2. The very important part, the year over year reading, markets were anticipating 3%. Well, this morning we got 2.9. As it sits right now, the market is still digesting, but this is a very, very good sign. And again, the reason I say it's a good sign is last month, December, when Jerome Powell spoke, he had indicated that the Fed would start entertaining rates cutting before hitting that 2% mark target. So yes, 2.9 is not 2%, but it's a two handle. First time we've seen a two handle in almost 2 years. So here, if this momentum continues, the acceleration as to when the Fed can start cutting rates could be here sooner rather than later. So again, Yes, the market this week was volatile. It's, moving all around, oscillating, and it comes to the point that the market is eager for data to support the narrative of when the Fed will start cutting rates. But additionally, we are eagerly awaiting the Fed next week to give us more information of when we can expect rates to start coming down. All that said, housing remains robust. We got building starts and new permits and new housing sales, and again, it blew past expectations. So, as the narrative continues, the American consumer and the buyer are out in full force. They're taking these lower rates compared to where they were in October and looking at this is purchasing in the form of a discount on real estate. And we know rates will come down. We don't know when, but we have seen empirical data to support that rates will continue their descent down. And inventory levels being where they're at, the competition is only going to get more fierce. We're already seeing multiple counters, multiple offers, you name it. The narrative needs to continue to remain. The buyers need to take action now. They can't be waiting. And we're here to deliver that message. If you need help in conveying this information to your clients, we're here and happy to support. Make it a great day and an even greater weekend. Thank you.